Hello everyone, and welcome to another episode of Hedge Fund Huddle. That's where we dive into different areas of the hedge fund world, looking to peel back the curtain and show you, the listeners, just how the magic happens. My name is Jamie McDonald, I'm your host as usual, and this week we are focusing on the hot topic of ETFs. Now, I say hot topic because it is impossible to deny the relentless popularity of these exchange-traded funds. There are now more ETFs than stocks to trade. Their assets under management is now over $13 trillion. That's doubled since 2020. And there are new laws that have meant more structures can be run inside ETFs than ever before. ETFs are becoming the way to invest. So what's going on, and can anything stop them? Well, lucky enough, I have two experts to help me answer those questions today. We have Wes Gray, who's Alpha Architect CEO and CIO. He has an MBA and PhD in finance from the University of Chicago. He was formerly a finance professor at Drexel University and was also formerly a captain in the US Marine Corps. Harley Bassman is managing partner at Simplify. He's the creator of the Move Index. Previously, he worked at PIMCO and is the author of the Convexity Maven. Wes and Harley, welcome to the show.
Thanks for having me.
Thank you very much. Great to be here.
So just to begin with, guys, we're going to start with some pretty broad questions. If you could both introduce yourselves, tell me about your journey to get where you are today, how you got into the world of ETFs, and the first question being, what's your version of why ETFs continue to go from strength to strength? And maybe Wes, we'll start with you.
Yeah, sure. So we started our biz about 15 years ago, around 2010. And then several years later, we identified the ETF as the world's greatest tax-efficient investment vehicle and dived on that grenade and basically been in the business ever since. And we currently operate around, 60 funds and $14 billion worth of ETFs. And I think the reason ETFs have dominated and will continue to dominate is simple. They're affordable, they're tax efficient, and they are very transparent. And consumers generally like those features.
Okay, and let's just talk about your clients, if you don't mind. So who's the typical client who comes your way, and what sort of service do you provide them?
So we see everything, but predominantly we typically have investment strategies that are relatively evergreen in the sense that we don't focus on the triple levered, Bitcoin ETFs at our shop. It's kind of more like fuddy-duddy, old school, traditional investment approaches in, various forms of that. And then usually the client that comes to us is very focused on tax efficiency. And so one of the things we specialize and focus on is how do we leverage the ETF wrapper to maximize the tax efficiency of the investment strategy you're trying to put in there. So that's going to be your, family offices, big institutions, big asset managers that have taxable clients.
Got it. And Harley, same question to you.
Well, I'm also use Chicago, so I'm a monetarist, which is popular sometimes and other times not. I spent 26 years at Merrill Lynch, where I at various times ran mortgage trading and option trading. In a nutshell, I'm a derivatives geek. I'm a convexity geek, and that's kind of where I've specialized in. I was at Credit Suisse for a while, at PIMCO for a while. I retired and then got drawn back in to the ETF world at Simplify when the rules changed and allowed derivatives to get put into ETFs. This is a real game changer. It's a way to go and offer civilians professional tools, and that's where I focus on. And the ETF wrapper is, at this stage of the game, aside from being tax efficient, which is great, it just allows you to put a lot of interesting things into an ETF that ordinarily you couldn't do. It also allows there to be trading and I could call it asset management, like rolling option trades or things like that, which would be very time consuming. For an individual, maybe they could do it. For any kind of large RIA, there's no way they could go and trade, anything and drop it into 100 accounts separately. We actually sell to institutions also. It's almost shocking because they could do a lot of the stuff we do, but at the fees we charge, it's just much cheaper for us to do it than for them to do it.
So I'm going to get a little geeky. Is this the rule in 2020, which the SEC announced 18F4? This is what changed what could go inside the ETF?
I believe so, yeah. Wes?
Yeah, that's a derivative policy overhaul where, basically in the old days, I know you have a lot of hedge fund managers on here. So as you know, like if I have $100 and I do $100 long and $100 short, I haven't actually taken a lot of risk, right? Because I'm basically long the market, short the market, and I'm betting on a spread bet. So you shouldn't be penalized as being massively leveraged or risky if you're doing a strategy like that. We should be able to think sensibly and say, wait a second, this is actually not a lot of risk. Therefore, you should be able to do it in the ETF. So basically the SEC, overhauled that program where you can be smart about assessing risk and risk management like actual investment strategy, and not just look at what they call like the gross leverage and say, oh, that's just highly levered. An example of like a market neutral long short strategy, it may look like it has a lot of gross leverage. It can be very risky, but obviously it's not very risky because you're just betting on a little spread bet between stocks.
So Wes has a very good point there. There's two kinds of leverage. There's the bad kind that people always talk about. We actually had economic leverage. These 2x and 3x funds. That's economic leverage. You make or lose 2 or 3 times your money given. So if you bet 100, you can make or lose 300. That's economic leverage. There's then notional leverage, which is totally different. And that's where you go and use. So for instance, if you could buy the 2-year treasury, or you could buy a 2 years futures contract, or you could buy the first 8 Eurodollar contracts. It's all the same risk, but they all have different amounts of dollars posted on your screen. And it is very important to recognize. And most people are involved in notional leverage, not economic leverage.
Okay. Yeah, that is a good point. Well, I think we'll come back to that point of leverage a bit later, because Wes, I want to talk to you about a hedge fund's ability to become an ETF. But first of all, if you could just like walk us through a little bit and maybe compare it with mutual funds, just for people who don't quite understand the difference with the tax and cost structures of ETFs, things like expense ratios relative to mutual funds. And is there a difference between the way it works in the US and Europe?
Yeah, so let me just walk through the tax piece, and I'll way oversimplify this just to highlight the mechanisms. This is not exactly correct, but a lot of people, at least in the US audience, are going to probably be familiar with 1031 exchanges with real estate, where, I go buy a commercial building, it goes from $1 to $100. I don't like it. I'll go buy another commercial building, but I can use a 1031 exchange and roll into the other building without having to pay tax. Essentially, there's a very similar mechanism through the ETF structure. So again, oversimplified example. An ETF versus a mutual fund, or really a mutual fund, hedge fund, or an SMA. Let's say that Harley buys Exxon at $1. Or sorry, that's a bad example. He buys NVIDIA at $1. It goes to $1,000. And Harley's like, you know what? I'm tired of these growth stocks. I'm going to go buy value stocks. So in a mutual fund, in a managed account, or a hedge fund, what would happen? Well, I would sell NVIDIA, incurring a massive capital gain, take the proceeds and turn around and go buy Exxon. Now, an ETF could do that if it wanted to, but why would you if you have another capability? So ETFs have an ability to transact in kind via baskets. And when you transact via a basket, it's non-taxable under the RIC statute. So what would the ETF do that's different than all other ways of doing this? Well, the ETF would say, well, we're not going to sell NVIDIA because then we got to pay a taxable gain right now. We're going to redeem NVIDIA out and then create in cash, or in this example here, Exxon. And by doing this through the basket formation, the ETF will not have a taxable event. So it can basically switch from NVIDIA to Exxon with no distributor liability. Now, that doesn't mean the tax is gone. It just means that it's in the NAV of the ETF, and you'll pay it eventually when you sell the ETF, but you're able to compound tax deferred, for 20, 30, 40 years if you wanted to. So that's a very key difference in the taxation of ETF structures versus all the others, and why, for taxable investors at least, this is it's a big deal. It's like a 401k, for all your money effectively.
Yeah. So, but I'm trying to think of what defines something as an ETF. For example, there's got to be a diversified portfolio for it to qualify as an ETF.
Yep.
Am I correct?
So,
like how many different assets do you need?
Yeah. So all ETFs and mutual funds have to qualify. Well, they don't have to, but generally they qualify as what they call a RIC, or a regulated investment company. And the reason you want to do that is a mutual fund or an ETF is set up as a C corporation. And C corporations just broadly get double taxed. But you wouldn't want to get double taxed on the, like, let's say you sell a stock in an ETF. You don't want to pay tax at that level and then also pay again when you dividend it out. So they all want to be qualified as a RIC to avoid double taxation. The key ways to qualify as a RIC is there is a tax diversification requirement. So no single security can be over 25% of the total. And then the other rule for the RIC statute, and this one's more complicated, is the sum of all your 5% and higher positions can't be more than 50% of the total. So for brain dead math, you're going to have like a 20 stock portfolio or more, just vaguely to qualify. And that's like a key component. And then the other big component of RIC statute is not exactly, but for all intents and purposes, you have to distribute all dividend, interest income, and capital gains every year to avoid the double taxation. So all mutual funds and ETFs do that, and they're very similar, except again, ETFs have this very unique ability in particular to minimize capital gain leakage through the custom rebalance process, which mutual funds just really can't do pragmatically.
Let me add one thing here to Wes's point. People get hung up on the idea of paying taxes. They don't want to give money to the government. The really bigger deal here is this. In its example of NVIDIA, from $1 to $1,000, if it was taxed, you get your $1,000 profit, but you'd pay $400 to the government, so you can only reinvest $600. And that's the bigger deal, actually, is you're reducing your ability to reinvest. So it just destroys investing that way. Even if you're writing a check, you'd be happy to do that. It's being able to maintain the dollar investment as time goes by.
Exactly. Yeah. Compound tax deferral, which is why Warren Buffett's so rich, and a lot of people that never pay taxes get so rich.
Harley, let's turn it over to you and discuss how somebody comes up with a good idea for an ETF. I was looking on the Simplify website. Something which struck me was the Simplify US Equity plus Bitcoin ETF. And it's amazing that you're able to sort of do that now. So how do you go about coming up with these ideas? How do you go about structuring them? That sort of thought process.
Well, there's two different ideas over here. One is to actually come up with the idea. The other is actually processing it, which could be a challenge. And I'll say at our firm, I kind of describe it as I go into the forest and, get a stick and I whip the pigs and bring these good looking pigs back to the factory. They walk into the factory and then they get processed. And I run around and I get nice bacon and a cellophane wrapper and sell them. That's where I'm involved in stuff. The actual processing of the ETF is kind of a different animal, which Wes is involved in. Coming up with an idea, a lot of times it can be driven by customer inquiry, but other times it's just a matter of going to the bar, having a drink, and thinking about what we can offer people. A lot of it is offering professional notions to civilians, which they have no access to. Sometimes just the access alone is good enough to sell the product. Other times, the creation of the idea, there's an ease of use, which is a value. So like, the ETFs where they go and they buy 10 or 20 oil stocks. Yeah, anyone could do that. It is not hard, ignoring the tax implications, but it's a hassle. So providing a service for that. So there's a whole range of things. This is why you have more ETFs than stocks right now, is because it's a service industry as opposed to, an advisor industry.
But we are at a stage now in the market where in terms of the progress that's being made in terms of ETF production, you are really only limited by your own imagination at this point. There's very little that can't be expressed within a correctly formed ETF. Does that sound about right?
That's true, but I think what you're seeing is a slow process over here. Like, remember the original mutual fund, you invested your money, you called up, Fidelity or Vanguard or whoever, and you'd give them a check at 4:00, and you'd get in or out at the NAB at 4:00. Trading once a day. The market's up at noon, you want to sell, but it goes down at 4:00 and you're sorry. That's okay. It's still a convenience. The ETF allowed you to go and basically trade that mutual fund all day long on a liquid stock exchange with total transparency to see everything going on. That's like level one. Level two is now adding in more interesting ideas that are, either futures or options or whatever into a package. That's where we're at right now. Number three, which is we're on the cusp of, is active into a ETF, kind of a hedge fund into an ETF. And that's kind of the new territory that we're working on. At Simplify, we have a number of these things. We have a healthcare ETF that's actively managed, but we also have we have a fund that does commodity trend following. It's your standard, ordinary, like Paul Tudor Jones kind of trend following. The math there is not too hard to go figure out. But instead of being a hedge fund where you pay large fees, where it takes you 5 months to get out, right? You have to give 60-day notice for a 3-month exit. I mean, we go and let you in and out in a day, and for a much lower fee. So it slowly you're going to see the ETF world cannibalize the hedge fund world. It's going to take a while for that to happen, but you will see this slow process happen as we commoditize products for civilians.
I wanted to ask about synthetic versus physical ETFs. And the angle I'm thinking about with this is ETF popularity is exploding. And with that is going to attract a lot of people who want to get, inverted commas, in on the action. They're like, okay, there's a lot of people making a lot of money in ETFs. I want to get in. And with that is going to attract, as it inevitably does in finance, possibly some bad actors. So if you're out there looking at ETF trading, like what are the things to look for in the fact sheet? If people are out there and they're not as experienced as you guys are in the world of ETFs, what is meant by physical versus synthetic ETF? I just assumed, even the word synthetic might be like, uh-oh, here we go again. This sounds like some leverage is being used where I don't know what it is. So what comfort can you give people, or how should people approach investing in ETFs? And what should they be looking for on the fact sheets?
So in general, I would say in what they're called registered funds, because we have to go to the SEC, do a registration statement, and our business is like the most regulated thing on the planet Earth. I think the SEC does a very good job of ensuring that you have to transparently convey what the risk and what the heck you're doing. Also, there's a level at the broker-dealer level where if you have complex products or things that do weird leverage strategies, generally the broker-dealer, like your Schwab, Fidelity, what have you, it's going to have a warning. Hey, you were about to buy a product that could light your hair on fire. Are you sure you want to do this? Check the box. So I think that, I'm also kind of like an individual, free market guy. And if you do stupid stuff at some level, that's your problem. And we're not here to babysit you. And I think our industry does do a pretty good job of and it should be pretty obvious when you buy the 3x Bitcoin ETF that you could get your face ripped off. I'm not that worried about it. So what I would be more worried about to the audience is when you're in private space, unregistered space, where now there aren't regulators, there's not a bunch of compliance and lawyers everywhere to protect you. That's where I'd be careful. But I honestly just read the prospectus. And when you see the big red X that says this is dangerous and you click through it, well, that's your problem at this point. You at least acknowledge it. And I don't think we hide, things that are crazy anymore in the ETF space. It should be pretty obvious to most people.
Yeah, there's a story in the Wall Street Journal a few weeks ago about, people who got kind of hoodwinked by an insurance kind of product that wasn't really there. And that's very sad. That's outright fraud. There's very rare to have fraud in the ETF space where it's a registered product. The SEC is all over you. This is the most highly regulated business out there, as it should be. We are dealing with people's money. It is the government's job to go ensure that there's no bad actors out there. So I don't think you're going to go and have that kind of issue. However, what you might have is getting into the wrong product for you relative to your goals and your risk. If something looks too good to be true, it might well be. If you have a very high yielding product, it's not fraud. It's a lot of risk, and there could be risk there. It's like when you buy high yield junk bonds, you're getting a much higher yield, but by the way, they're called junk bonds for a reason. So I think it's very important to match your goals and expectations with the product. And of course, you should go look at the underlying company and make sure they have the ability to go and deliver what they advertise. And once again, all the larger ones are fine. The medium-sized ones, they're pretty good also. The younger ones, you got to go look through it and see who's there and why they're doing it. And just do your homework on stuff. But in general, if you buy a listed product, there's not going to be fraud. There's just going to be market risk.
Yeah. So Harley, I wanted to go back to what you said about actively versus passively managed ETFs. Maybe you guys can give a little history about that, because I know that's an area which is starting from a small base, but is growing pretty fast. And Wes, then maybe you can touch on, we've spoken before that, I worked at a long short equity shop, which doesn't actually fit that well into an ETF type structure. It's just it's too fast, and there's too many moving parts. It's a bit complicated. But a more simple sort of long only managed fund, like why would they not turn themselves into an ETF at this point? So maybe Harley, you can start with what's going on in managed versus passive ETFs.
Well, I mean, the old expression, a hedge fund is a compensation scheme masquerading as an asset class. Once you go into ETF space, you're going to have transparent lower fees, and you'll know what's going on. This is why you're seeing this kind of growth in the product. The difficulty in active and also just going away from pure listed products is that what we have to do is when you buy or sell these products, at the end of the day, the market maker has to come to the issuer, us, and buy or sell, redeem or create shares. We have to go and buy or sell from them at the 4 o'clock closing NAV. Now, this is easy to do for a listed product because you could put in a market on close order. You're guaranteed to get the 4 o'clock price. For the products, a lot of products I deal in, like these long-dated options or mortgage securities, there is no closing price. And therefore, the skill for us is to basically buy or sell somewhere near 4 o'clock to get that 4 o'clock price, because to the extent we don't get that price, we are either adding or subtracting value from the remaining shareholders. That's the trick. And when you get involved in an active strategy with less liquid items, it becomes more challenging to do that. So I view that as the limiting factor to doing this. The other thing is going to be this. We've approached a number of the larger hedge funds out to the name brand guys, about this. And the problem is they're not comfortable showing all the trades they have on. And that's the challenge. So we have a healthcare ETF. We'll show the stocks we own. We're not going to move the market, and they're all listed. You get other trades where you put on more complex strategies. They don't want to advertise those, and that is a limiting factor, especially people who are involved in more, I won't say sexy markets, but off the beaten path of market. And you see some of these the bigger hedge funds that make a lot of money. They're not buying SPY and just going for it, man. They're doing other things that are more interesting, and they don't want that to be known by their competitors or by other people in the market to front run them. So that's the ultimate challenge of the hedge fund into ETF is transacting at NAV at 4 o'clock, and then the transparency.
And I'll just dovetail because it goes right into the question that you mentioned about why doesn't every hedge fund strategy go into the ETF? And Harley, outlined it beautifully. Like, I mean, the bottom line is you cannot close capacity on an ETF, and you have to be transparent about your positions, right? So to the extent that you're trading in something that has capacity and it's not a problem to be transparent, like if I say, hey guys, I'm going to go buy Microsoft today. Who cares, right? If I say in another scenario, hey, I'm going to go buy Joe's Chicken Shack, a $10 million market cap special situation stock. Well, I might move the stock 100%. And fundamentally, that's just not going to work. So anything that, where transparency is going to kill the golden goose, and or that's intricately tied back to capacity. Like there's just, if you have too many dollars chasing too few opportunities, it'll blow the trade up. It does not make sense to have an ETF. But any strategy that has some runway for capacity, transparency, it may hurt it at the margin, but the tax benefits, the ease, and all these other things improve it. Like you were talking about, like plain vanilla kind of long only. Well, duh. We should probably put that in ETF. Your day traded long, short, quant, 1,000 long, 1,000 short, market neutral strategy. That's probably not going to be a great ETF, right? So it depends. It's not, an ETF is not a panacea for everything. It's just very good for things that transparency doesn't kill it, and capacity. There's some capacity in that marketplace that it could take $1 billion and not, blink an eye.
I think it's important that the issuer actually be very cognizant of liquidity and everything else. The idea might be clever, it might draw money in, but because I view it as a fiduciary duty for us to go and offer products that can be managed properly and offer value. Right now, you see in the paper about the company MicroStrategy that they go and they buy Bitcoin, and there's some 2x, 3x kind of versions of this. As far as I could tell from reading the paper, they've gotten over their skis on the amount of product they can buy to create the leverage. They're not going into the option market to go and buy the leverage because they can't get swap lines from their dealers. Well, this is really a bad idea because they're paying like gigantic option premiums for these options, as they should because the stock's volatile, but they don't have direct access anymore. They're paying an option premium that's going to burn away. And these funds they're not going to deliver. And you listen to what they're saying we're targeting a 2x. Not we're going to deliver, we're targeting that. And these funds recently have not been going, they've been lagging on the upside and accelerating on the downside. And the market doesn't move, you're going to burn that premium away. This is a product that's really kind of suspect. I mean, it's a good idea if it's 10 million. Once it gets to $1 billion or so, it's a problem. Wes, what do you think of those?
Yeah, I agree. That's one area you had an initial question about, like, what should investors be worried about? And this has been under debate amongst regulators for a while now. And trust me, I'm like a libertarian. I'm not into having a million rules for everything. But this is an area where I do believe for leverage or complex products, there should be like even a bigger kind of like cigarette smoking might kill you warning sign, because to Harley's point, like, they still allow a lot of things where, like, anyone with common sense would be like, who the hell would ever launch that product? Like, obviously there's no liquidity there and it's going to have a bad ending, but the SEC kind of like let it go through. And yeah, there's a sure warning. There's a few warnings on that thing, but it'd be nice to have like disclaimer, you will probably die if you buy this. It doesn't, like, just make it even more painfully obvious, but we're not there yet. And that proposal's been up before. And it got, I don't know if there's vested interest or whatever, or maybe people just don't want more regulation. But yeah, and there is a rule. You're not supposed to have over 50% of the assets in an ETF that are deemed illiquid, because you have to run another thing called LRMP, liquidity risk management programs. The problem is the SEC says, well, you have to have a reasonable assessment of liquidity. Well, the problem with that is you opened up the gate to, like, well, what's reasonable? Like, maybe, Harlan and I might say, well, that strategy there, that's absolutely insane because it's reasonable to say that there is no liquidity at any scale there. But then someone else might be like, well, I think it's reasonable that there'll be liquidity. And so that the problem is they let a little bit of gray zone on liquidity risk management policies, and you kind of get a self-define what is illiquid. And obviously when people get a self-defined illiquid, well, you might magically find that, there's maybe way more illiquid stuff in there than you might have thought.
Well, I'm sure we can all think of like credit markets, which are liquid for a long time. And then when they freeze up, history is not a great predictor of the future. And, that liquidity is not something you can rely on.
Well, I will throw a lifeline to regulators as much as they can be troublesome. They've tried to do stuff. The problem is you just can't. You can't capture the idea that they have VAR limits, they have other things. But for instance, let's just say use leverage ratios. I'd rather have 5x or 10x the US 10-year note than 1x Bitcoin. But how do you go and how do you make a rule for that and say, well, you can do Bitcoin, but you can't do treasuries? I mean, you just say there's a leverage limit, there's a vol limit, this, that. They're trying to go and make reasonable rules, but there's always things on the margin that are challenging, and the government really can't go and do line by line saying this is legal, this is not. They got to do these grand things, and they just hope to God that will cover the process, and there'll be good actors out there. The GFC in 0809 was kind of the problem. There is they didn't have quite enough rules. They kind of relied upon good actors, but it wasn't line item saying if someone can't afford a house, then you can't sell it to them. They didn't have that rule. Like, they kind of thought common sense would cover it. Turns out it doesn't. So these are challenges. It's a feature, not a bug in some ways, because it does allow for creativity. If you go and make a line item for everything, then you have nothing. Sometimes you got to take a little risk to go and get the larger good.
I agree. And that's the trade-off. Like, it's just innovation versus, like, regulation overload. And in some sense, like, as a boutique operator and someone that helps other people do innovation, and I know Harley and Simplify, they're in this bucket, we probably in general would want less regs so we get more flexibility. But obviously, like, the monopolist competitors out there, like your iShares, they're so big they love more regulation. They love more compliance because that's just squeezing us and our ability to compete, to do innovation. So there's always going to be a trade-off. Like, do you want the market to be more innovative and come up with new ideas quicker, but we maybe have some bad eggs and things pop through? Or do you just go like overlord, and then guess who's going to win that game? The guys who are the biggest, that have the most money, they can jam more rules. So Harley and I are out of business because we're like, hey, we need $50 million just to pay for compliance to deal with all the rules, right? So you always have trade-offs in these markets, and that's why we have to think through these things.
A couple of different style questions. Firstly, I had one about ownership. When it comes to, things like voting rights. I mean, if you're the owner of an index, you're another step removed from voting at any of these AGMs or being in touch with the company. And then with the ETF, it's another step removed. So how does that work? I mean, who is controlling the voting rights when it comes to these companies at AGMs?
The advisors who are hired by the trust to advise the ETF, they have a fiduciary obligation to do that on your behalf, right? Like, so like if you run an ETF, you have an obligation to vote those securities in the best interest of your, shareholders and your investment mandate, and what is that? So that means if you have like an ESG mandate, let's say, and that's part of your role, and that's what you've sold people, well, obviously you don't want to say like Exxon's the greatest thing ever for solar, because that would be against your rules. But you are under that obligation as the fiduciary who's providing advice to the fund to vote the proxies in the interest of whatever you're trying to achieve.
So you're just voting in line with the objectives set out with the fund.
Yes. Now they have new technologies of how, I don't know how they do this legally, where they're like delegating the vote down to maybe collect opinions from the shareholder base. But I still think from a regulatory 40 Act standpoint that the actual bona fide advisors who are hired to provide investment advice to the trust still probably have to legally vote them. I'm not an expert on like kind of the new ways that they're trying to syndicate votes and get input, because I know there's people out there doing that.
Well, you do see in the paper all the time, Larry Fink is the financial overlord taking over the country. I mean, yeah, what do you do? They run the biggest fund out there, and they vote the shares. This is a challenge to go and do it, because certainly everyone's not going to vote the same way. But when they vote all the same way. You just got to once again hope that there's, good spirit and fiduciary work going on over here. And I would say in general that I kind of trust these guys. The real big boys are mostly good actors. I'm much more worried about the flash dance people.
We have a firm on our platform called Strive, which is owned by Vivek Ramaswamy.
Oh, Vivek, yeah.
He was like a famous politician. And actually the whole mission of Strive was to make it where it's all about excellence and capitalism, and we're going to vote and do those mandates. We're not going to do the Larry Fink control the boardroom type stuff. So they actually weirdly did, their whole pitch was like the investment process is basically going to be the same, except we're going to be active and vote differently at the proxy vote box. And so you do, and we have also funds on our platform that are like, extreme ESG as well. We don't really care. I'm just selling a shovel here to make sure that you can fulfill your dreams in life. But you do see this as kind of an internal competition where people extract away from the investment benefits of what you're doing, and they're very focused on the activism and like, providing your vote or your input to the marketplace on, board matters.
So Wes, I'm actually looking at the Strive 500 ETF fact sheet.
Yeah.
How does that differ from basically the spiders?
It's fundamentally, it's going to be 99.99% same. What's different in that particular case is their activism behind the scene to, cause with their whole pitch was like,
They're
hey, we
only
want to
voting for shareholder value.
Yes, we don't care about these other things. We're how do we maximize shareholder, like Milton Friedman, old school Chicago style? That's what we're going to do, and that's what we promote. So if you vote with your money and you buy our, S&P 500 fund versus Joe Blow's S&P 500 fund, you can at least be assured that we will be voting in this way. So as you can imagine in the States, 50% of people are like, well, that's a terrible idea. But there's another 50% of people or I guess after last election, maybe, 52% of the people that are like, hell yeah, let's do that. So it's just it's a marketplace for ideas. And, and that's just, the consumers, there's a big swath of consumers that wanted that, which is what Strive was trying to go after.
Got it. And we're sticking with you. I won't mention numbers unless you allow me to, but
Sure.
someone's listening and they've got a $25 million fund and they're like, all right, I want to flip this into an ETF. I'm going to give you a call. How long does it take? How much does it cost? Basic numbers.
Yeah, I'll give you basic numbers, just back the envelope, just basically prevent a million calls coming my way here. And so I'm going to sandbag this a little bit.
How much commission am I getting on the,
Yeah, exactly. Well, we're in the ETF business, so there's not a lot of commissions for anybody, unfortunately.
I'll take Christmas drinks.
That'll work. We can facilitate that. But generally, just generically speaking, you want to go to like we're called like a white label provider, like someone who's basically going to do all the monkey work behind the scenes, and you just go launch the fund and sell it. It's usually like around a 4-month process, soup to nuts. So, hey, let's do this. Great. 4 months from now, we probably can have an ETF, plus or minus some noise, right? Depending on complexity. And then cost-wise, generically speaking, like your all-in kind of startup cost is around 50 grand. So just take 50 grand, light it on fire. Great, you're going to have an ETF we can launch. And then your annual burn rate for someone to basically do everything outside of like selling this fund and sending me the spreadsheet with intellectual property, it's probably going to be all in soup to nuts, probably around 200K a year. And just for easy math, consider it fixed. So what the heck does that mean? Well, I'm not saying you could charge 1%, but let's pretend we got blessed and you could actually charge 1%. Well, if it costs me 200K a year, well, I need 20 million just to break even, right? And then the beautiful thing though is it's kind of like software. The first CD is extremely expensive and has massive fixed cost. But after you get past that fixed cost, you have a lot of operating leverage. So your marginal cost production for every new CD you produce is like a penny, right? So it's roughly analogous to the ETF business. Like a lot of fixed costs, a lot of burning money on fire. But if you can get to that break even and scale, it's a very profitable business. But if you can't, it's the worst idea on the planet Earth.
Harley, last kind of question to you where we're sort of wrapping up. We've got a changing government coming in the US, obviously, as we head towards the end of 2024. Regulation-wise, do you see any big changes that are going to happen in the finance world, whether it's related to ETF or not? I just wondered if a kind of a deregulation is going to happen.
Look, with Donald Trump, and I'm trying to avoid politics too much.
We're not a politics show. As it relates.
Well, no, you guys. I mean, you take him seriously, but not literally. Is the common theme here? It's unclear what he wants to do, and I think people should be, should not be surprised with what happens either way. Do I think it's going to be giant changes in policy? No, I don't. I do think that it is important to consider, the possible outcomes. I mean, tariffs would be a negative for prices for the economy, but tariffs may be a good public policy to go onshore, vital national interest goods. So, I mean, there's a money issue and there's a public policy issue. Unclear where that balance is. Immigration, once again, the economy is GDP equals people times hours times productivity. That's it. People, hours, productivity. We've had immigration into the country of some number, 4 million, 20 million, I'm not sure. And that's probably supported our GDP. If we reduce that, that will be a negative for GDP. Once again, might be a good public policy from your standpoint to go and reduce illegal immigration. I have a problem with that, but there's a trade-off. And people should be considering how those might play off and go from there. My motto is sizing is more important than entry level. Sizing is more important than entry level. Do not try to pick tops and bottom. You will not do that. That will never happen. You want to be big enough in a trade, so if you're right, it makes an impact. And if you're wrong, you're not stopped out. People who get in trouble, invariably, it's not because they have a bad idea. They just have it on too big. And I think if you do that going ahead, you may well have an insight or a thought about what's going to happen in the next 90 days or the next year. Size it properly and you'll be okay.
We used to have an expression when I was in the hedge fund world that only monkeys pick bottoms. So there you go. Before we wrap up, tell us a little bit about the Convexity Maven. How do people read it? How do people get hold of you if they want to?
So I write a commentary intermittently every 4 to 8 weeks. It's free. They're all posted on my website, convexitymaven.com. You can send me an email and I'll add you to the list. And, the idea is I try to go and write about, interesting thoughts for the market, sometimes a little high level, but, focusing on, ways to go and get yourself in a position where you have a better risk return payoff for an idea. And of course, I'm managing partner at Simplify. We just bought a brand new product. Today we're reporting on Tuesday the 10th. A very interesting product where you're buying a 7-year call option on the 10-year Treasury. It is extraordinarily powerful as a 43 duration, so it's 3 times as powerful as the 30-year Treasury. It's a very interesting product for capital efficiency, and we try to once again bring ideas like that where it's suitable for people. And you go to my website and you'll find the commentary on it right there.
Awesome stuff. And same to you, Wes. How do people get in touch with you if they want to?
Yep. So if you're interested in launching an ETF, you would go to etfarchitect.com and we'll tell you everything about it. And then if you're interested in like geeky quant research and, alpha architect things, you would go to alphaarchitect.com, where we have a weekly published blog. You can learn about like our funds and service offerings and what have you. So, and I'm on X, which I still call Twitter. It's just at Alpha Architect. That's where I usually hang out from a social media perspective.
Harley, Wes, this has been such a pleasure. Thank you for talking to me today about the world of ETFs, which is hot and getting hotter by the sounds of things. So thank you both very much. Thanks once again for listening, everyone. And please, as usual, give us a follow, like us, or subscribe to us wherever you get your podcasts. The information contained in this podcast does not constitute a recommendation from any LSEG entity to the listener. The views expressed in this podcast are not necessarily those of LSEG, and LSEG is not providing any investment, financial, economic, legal, accounting, or tax advice or recommendations in this podcast. Neither LSEG nor any of its affiliates make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast, and any and all liability, therefore, whether direct or indirect, is expressly disclaimed. For further information, visit the show notes of this podcast or lseg.com.